You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way, as you're listening to News Talk 98.7 WOKI. And, you know, the U.S. and global economies, we're certainly navigating a complex landscape. Right now, we're being shaped by inflation trends, trade policy, a lot of geopolitical uncertainties. These factors continue to influence investor sentiment and shape expectations for economic growth and market performance. How does our mounting federal debt impact the economy long term? What about the federal balance of the dual mandate of stable employment and stable prices, or full employment and stable prices? What's the impact of this tariff yo-yo? I've been asked many, many times, you know, what's the long-term impact of the type of yo-yoing that we see? Our guest today is Andy Puckett. Andy is a professor in the Department of Finance at the University of Tennessee, and he is Knoxville's Haslam College of Business and a Charles Dorothy Duggan Faculty Research Fellow. He received his bachelor's in finance from Auburn University. We'll forgive him for that. And his Ph.D. from the University of Georgia. Not sure we'll forgive him for that. He teaches both undergraduate and graduate students in the areas of investments and financial technology. And before coming to UT, he served on the faculty at the University of Missouri for 4 years. Good morning, Andy. Welcome to More Living.
Good morning. It's great to be here. Thanks.
Great to have you with us. So what drew you to the world of finance?
So that is a long and sordid story, but I'll give you the quick overview of that. So I started out as a finance major in college at Auburn. I was drawn to it. I had an uncle who was a bond trader and had many conversations with him and found that I had both an aptitude and interest in that area, and then came out of college and worked with a group called Payne Weber for a number of years, and then Prudential Securities, and had a long-time relationship with a former professor at Auburn, and we started talking about what does it look like to get into academia and go back and get a PhD, and one thing led to another, and here I am with you. So
were you drawn at that time? Just you were in private industry in the finance world, so then you got drawn to academics. Was there something that spurred that, or was it just you were drawn to the teaching element of it? Tell me what led to that.
I thought I would really enjoy the teaching element of it. I had done in industry. I had facilitated some teaching activities. I'd taught several groups. I really enjoyed that. I liked the academic setting. I thought I would like research on that side. And the more I talked to people, the more I thought that I would like that kind of activity and that kind of career. And it turned out to be a great move for me. So it's something that I really fit in well. So very happy that worked out. And if it weren't for that, I wouldn't be in Knoxville. So we have raised 2 kids in Knoxville. We've been here exactly 16 years.
So you're a Tennessee Vol now.
And for all intents and purposes, I am cheering for Tennessee. My wife, on the other hand, went to the University of Alabama. She has not fully converted. She's like 75%. So we push her every year.
So she's like for Tennessee unless they're playing Alabama.
Yeah. Yeah. And even, I will say this, and I might get in trouble since I'm saying it on the air, but even when Tennessee plays Alabama in basketball, she will root for Tennessee.
That's great.
It's just football that she has the problem with.
Well, let's talk about everything that's going on. You know, there's been a lot in the news. Of course, we got all the tariff stuff. Before we even get to that, GDP growth for the first quarter was negative. But is that misleading? Because, you know, net exports is a part of that equation, and there were huge amounts of imports coming in the first quarter because people were trying to get ahead of the tariff stuff.
Yeah, my sense is you mentioned the tariff yo-yo. There's a lot of things going on right now, and I don't think we fully understand the impact of these accelerated purchases, firms bringing in massive amounts of imports and how much they're stockpiling. I don't think we'll know this for months or more. So the effects of all of this, I would say, tariffs and the spillover effects into the larger economy, I don't think we really understand what the net effect of all this is for the long run.
Well, and I think nobody thinks that where we are right now today is where we'll necessarily be in 90 days in terms of tariff policy.
Oh,
I don't think anybody thinks that.
I knew tariff policy would come up today because it is the topic of the day most days when we talk about financial markets and what's going on. Not only do I not think we'll know what's going on or that we know what's going to happen in 90 days, I don't think we know what's going to happen on Monday. So this
absolutely.
Tariff policy has been pockmarked by, policies being set in place and rescinded, sometimes on the same day, sometimes 1 or 2 days later. We've had some recent court rulings this last week, one which shot down the administration's tariff policy, and the next day a federal court of appeals put a stay on that ruling. So we are literally yo-yoing back and forth day by day. I think there are some metrics that the underlying economy is healthy right now.
Yeah, consumer spending is still pretty strong.
Consumer spending is strong. So on the personal side, and this is just an anecdote, but my wife owns a women's clothing store in town, and consumer spending from her perspective is as healthy as it's been in any recent year. So I think
that's very interesting to hear that.
Is healthy on many dimensions. But there are some anxieties. One thing I heard recently, which I think is very interesting, is we have typically paid a lot of attention to this construct called consumer sentiment, how people are feeling about the economy. And I think people say they are feeling very anxious, but I was listening to Chicago Fed President Alan Goolsbee talk about sentiment and forecasts of economic activity.
Usually when sentiment is lower, the next 12 months is pretty dang good.
Yeah, well, he said
that whole contrarian thing.
It negatively in the last few years, it negatively forecasts economic activity. So when consumer sentiment has been low, economic activity has been high.
Isn't that interesting?
So very interesting.
Let's talk about investor behavior and what happened in the month of April and where investors can get really tripped up. It was so choppy and volatile in April. And, the sky was falling. We saw news reports of the trillions of dollars that was being lost in the market. It's funny because I didn't see many articles about the $1 trillion that was made in the day that the market came back 9.5%. But because that's the way the media is, it sensationalizes. But the reality is, if you went to bed on March 31st and woke up on May 2nd, the S&P 500 in April was down 0.5%, roughly. You'd have thought nothing really much happened in the month of April. But the reality is we were whipsawing around. Talk about the challenges with investor behavior and the danger of human emotion in those types of markets.
Yeah, I think one of the challenges, and this has always been true, is that when you get paid for being in markets is when nobody wants to be in the markets, right? When you actually get the additional return or the payoff for being in equity markets is when it's really, really hard to attract dollars in equity markets. So if you looked at any period of time, right, If you look just after the financial crisis of 2008, at those market lows, nobody wanted to put money in equity markets, and returns have been tremendous since the low, which was March of 2009, to now. In the same way, there has been, I'm ballparking here, but about a 20% return from the April 5th lows after the reciprocal tariffs were announced and markets went down by 10, 12%. So from April 5th to now, there's been roughly a 20% return in equities. Now, that doesn't cover all sectors of the market, but it is representative of the S&P 500, which is, at least for me, my preferred gauge of what's going on in the markets.
We're visiting with Dr. Andy Puckett, and we're talking about some of the financial world today and the impact of tariff policy. We're also going to get into the U.S. debt and deficit spending and the longer-term outlook of where we are with that. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. We're visiting with Andy Puckett, and he's a professor over at the University of Tennessee, someone we've known his family for quite some time. And we're talking about the impact on the markets of everything that's going on right now. I want to get to the debt and deficit spending, Andy, but before I do, we were talking about investor behavior, and you'd said, where it really pays to be invested, you got to be invested in that, in the times people don't want to be investing in stocks. The emotion, we know that. I'll never forget, I took a 6-hour finance block with Jim Wansley and Dr. Daves and a couple other people in my second year of my MBA program, which is what turned me on to investment finance, because I was going into the music business. And I'll never forget, they got up there in the very first class, they told us 3 or 4 things initially, and one of them was buy low, sell high. We all know that, right?
Right.
But people don't want to buy when the market's cratering,
right. And
people want to sell. They don't want to sell when the market's at all-time highs. People want to do the opposite emotionally.
Yeah. So on the academic side of things, we use this fancy term called the market risk premium, but all that means is the amount above and over the risk-free rate that you're getting paid for being in equity markets. So it's the premium you get for taking on risk. And what we know is that premium varies over time. And so at times when the market is really high and everybody's excited to be in the market and they're throwing money at the market, those are times when the market risk premium, the premium you can expect to get over the next 5 or 10 years is really low. When markets are choppy and volatile and nobody wants to get involved, those are times when that market risk premium is really high. So the payoff for being in equities, at least in expectation, is really high over the next 5 and 10 years.
And ultimately, I believe very strongly that nobody can really time things. And one of the problems with timing the market is you have to be right twice. Not only when you sell, but then when do you buy back in? And if you go back and look at the last 20 years, last 50 years, whatever you look at, a lot of the best days in the stock market have followed some of the worst days in the stock market. So trading into that yo-yo can be very dangerous. Do you agree?
Agreed. I mean, you could even extend that to the best years. So the worst year in the last 150 years was 1931, and the best year from a percentage returns perspective was 1933. So both were in the Great Depression. Both were, I would say, unpredictable before the fact. So I'm not aware of any well done empirical scientific study that says people can time the market.
Absolutely. I like to say it's not timing of the market, it's the time in the market. And you got to have time on your side to run through the natural ups and downs, right? Time horizon. I talk about that all the time. If I need money next year, I shouldn't have that in stocks.
I agree with that wholeheartedly.
Yeah, because, who knows where the stocks will be in a year. But in 15 years, You know what? I wasn't going to ask you this, but I'm going to ask it to you anyway. If I'm looking out over the next 20 years, what is a bigger risk, stocks or bonds? If I'm diversified in the stock market and I don't buy and sell and time things versus owning bonds, what's a bigger risk, truly?
I mean, I will give a couple of answers to this. One is my personal portfolio is almost 0% in bonds right now. Yeah. Because I think the risks are enormous that at least on longer term bonds that rates go up, which is going to really hurt longer term bondholders. That doesn't mean that's what will happen, but I think the risks are very high. Equity markets historically have been the place to be if you have a 15 or 20 year time horizon. I have the majority of my assets in equity markets, both domestic and international.
But you're a fairly young guy, so you're not worried about retirement for quite a while.
I'm in my 50s. So
I thought you were in your late 40s. I guess if I'd really thought about that, I'd have known that.
Probably
I have a good bit more white hair than you do, Andy.
I'm thankful that you thought I was in my 40s. That makes me feel good. I'll leave here with a puffed out chest.
You were talking, I was like, how much younger is he than I am? I think he's probably 48, 49. Anyway, go ahead.
But I do think equities have the expected highest payoff over long periods of time.
They certainly have historically.
And historically, that's true. There is a tension there because we valuations are a little elevated in the equity markets right now. If you look at things like it's called the CAPE ratio, but this is just a fancy PE ratio that smooths some of the jagged earnings out over time.
It's purely based on historical, not any projected forward earnings.
Yeah, but it's based on work by a guy named Bob Shiller, who won a Nobel Prize in economics, and it's his work says that this CAPE ratio has high predictive ability of what stocks will do over the next 10 years. So we're a little frothy on some of those valuation ratios, which gives me pause to say, hey, things might be a little choppy, but from a personal perspective, I think equities present a compelling case over the next 15 or 20 years. So I'm in.
Yeah, I absolutely think over a longer holding period, bonds are the bigger risk. The past century, I saw a study last fall, the last century, 100 years, the real return of bonds, of long-term treasuries, and real return meaning the inflation, how much did we beat inflation, was zero. It was zero. Well, you're not compounding and growing wealth if all you're doing is keeping up with inflation. You're just keeping up with inflation. You're not growing and compounding wealth. But bonds provide a little bit more stability in the short term, right? As do other fixed instruments like CDs, anything that's a fixed bearing instrument that, as long as I hold it to maturity.
Right. I think that last part is really important, as long as you hold it to maturity. So 10, 15, and 20-year treasuries can be very volatile. Very volatile.
As a matter of fact, just the average, the average, the U.S. ag bond market in 2022 was down over 13%. So, and that's not even looking at the longer term treasuries. So the longer the term the bond, the more volatile it becomes from a price perspective.
Correct.
Right. Yeah. Well, let's dive into the debt and the deficit spending. It's starting to become very central in the conversation because of the, what Congress is trying to do and what Trump's trying to do with the great big bill. What's that thing called? Anyway, you know what I mean. So, at the end of April, U.S. debt clocked in at $36.2 trillion, and that represents 122% of our economic output. So that's 122% of GDP. And it's growing about $1 trillion every 3 months, which is a pretty alarming number. So what is your view of the federal debt? I know over the years, different economists have had different views of it's not necessarily a bad thing. At these levels, I mean, there are other countries that have higher debt. Japan jumps to mind. But at what point does this become a big problem in Europe, in your view? Or is it too nuanced to answer that directly?
No, I think I'm going to caveat all my answers with this because we don't have a crystal ball. We don't know if it's going to be a big problem. But economists have traditionally said if public debt, and what you were talking about with the public debt to total economic output ratio of 122%, that's just considering the public debt. That comes from the St. Louis Fed. But if that number ever gets above 100%, then that is cause for concern and we could have problems. Back in 2008, prior to the financial crisis, we were at 62%, just to give some context of how things have changed in the last roughly 20 years. And so I do think it's cause for concern. I think a lot of economists who actually do research in these areas are concerned about not only the levels of the debt, but the fact that the vast majority of our debt is issued over really short terms. So
it comes due and then it renews at higher interest rates.
That's right. So if interest rates go up, we basically have to refinance that debt at higher rates. It might be less concerned back when the 30-year bond was at paying 3% interest. If we had, it's almost like getting a 30-year mortgage at 3% on your house. You're not worried in that interim period about rates because you're locked into that 3% rate. Well, the U.S. had
but the bank that's covering that mortgage, they're very concerned, which is kind of a good example of why longer-term bonds are more volatile.
Exactly.
Because the mortgage holder's not glad that they're carrying debt at 3% right now.
That's right. That's right. So that's absolutely true. But from the U.S. government's perspective, they could have financed that debt on longer terms, and they haven't. So I think two things that are concerning about that. One is our debt service. So the interest that we have to pay on that debt is becoming a larger and larger
It's the number 2 line item now in our budget
of what we have to spend every year. If interest rates do go up, and still on a historical basis, we have relatively low rates. So if interest rates do go up to at or above historic norms, that will make even a larger and larger percentage of our annual budget. So that is concerning, and it crowds out other things. I think what is also concerning from my perspective is there's been no real attempt to stop the bleeding. So it doesn't.
It's just so politically dangerous.
It is really hard, and I think, in finance, we're in the business of thinking about incentives, and politics, they clearly follow incentives, and the incentives are to do what is expedient and in the now, and not think about
long term,
10 and 20 years from now. But I think it's really concerning. I hope we will turn that ship around and stop running such large budget deficits.
Well, and I know you mentioned the percentage. I mean, interest on the debt now with the growing debt and the increasing interest rates is now 14, 15% of GDP. It's number 2 or percent of the budget. And typically when it gets up around 14%, Wall Street starts to apply pressure because it's starting to get in a range where it's just going to be very difficult to maintain that. And I would just urge our listeners to kind of, as we go through all this over the next 3 months, there's just going to be so much sensationalism in the media. And, there's a short-term impact, there's a long-term impact, and we want to be careful we don't rush to too many judgments. And we certainly don't want to be trading on that information, I don't think.
I don't think so. And I actually think, so you pointed out one country in particular, one developed country in particular that has a really high debt to GDP ratio, which is Japan. And Japan's debt to GDP is well over 200%.
But they've had very slow economic growth for 30 years.
I was going to say that is, and even beyond that. So in 1989, the Nikkei, which is their version of the S&P 500, was at 40,000. Today, it's at 39,000. So their markets
Holy cow, I didn't know it was that bad.
Functionally zero for the last 35, 36 years.
So it's definitely been a weight on the Japanese economy. Is there a world, and is there a developed country that has a health, you consider a health, I don't know where you are on it, world macroeconomics, but is there one that's very healthy in terms of how they do their federal debt?
You are speaking way outside my area of expertise on that one. So,
seems like everybody's struggling with it. I mean, I've not seen anything. We hear about Japan on the other side, but I've never heard this country's doing it right.
I mean, my understanding is all developed countries, especially since the financial crisis and this accelerated after COVID, are running really large budget deficits.
Yeah, that was my understanding too. Okay, well, the stock market and investors have been responding to all of this. It's like they've been on a roller coaster. I talk a lot, and I want to ask you to touch this on this, Andy. You know what? I'll tell you what. We need to get to our next break.
Okay.
I'm lost track of time here, Wayne. Sorry about that. When we come back, we'll have more with Andy Puckett. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. This is More Living with Jim Brogan, where it's all about living the best years of your life your way. We're with you every Saturday here on News Talk 98.7 WOKI, 9 to 10 a.m., and again from 3 to 4 p.m. You can catch all of our podcasts. Go to Apple Podcast or Spotify. Type in More Living with Jim Brogan. It'll pop right up. We post our podcasts on our website every Tuesday afternoon, and so we have a bank of several years' worth of radio shows on there. So check all that out, broganfinancial.com. We've got a world of resources there for you to become better informed so you can make prudent decisions that can impact the quality of your life. We're talking about some of the challenges that have been going on in the markets. I do want to talk about understanding soft data versus hard data. And the reason I'm asking this, Andy, is because there have been a couple of things come out this week about the soft data looks almost apocalyptic, but the hard data, it doesn't look bad at all. So what does that really mean for investors that are reading financial news or digesting financial news?
So I am going to ask you a clarifying question. Do you know what they were talking about when they said the soft data?
Well, yeah, I mean, I have some information in here. I'm going to have to dig through my notes.
Hey, that's all good. I can talk about soft and hard data.
Just conceptually, let's just talk about hard and soft data.
That sounds great. So when we talk about hard data, we're talking about data that are quantified and verifiable. If you think about things like the consumer price index, which is one way that we gauge inflation in the economy, when the consumer price index comes in and we know a measure of that, and we know that, for example, the CPI at the end of April rose 2.3% from 12 months ago. That's a hard data thing. When I think about soft data, I think about things like how people are feeling about the economy, what people think about the future of the markets, perhaps what people think about inflation going forward. So we call that inflation expectations. Those are much harder to quantify. I'm not saying they're not important, but they don't have hard numbers associated with them. And often you get varying opinions. So, for example, Michigan does a consumer sentiment survey, but there are also other measures of investor sentiment around the country.
Well, and we talked about the danger of that, how it's inversely correlated to future market performance. But yeah, there was Friday data that came out with the consumer spending in particular sustaining at 5% year over year, which is very, very strong. But consumers don't realize that. Like the average consumer, as you mentioned, because of the sentiment, tends to feel, I don't know about things. So I guess the lesson for me, Andy, is we got to be very, very careful we don't make short-term decisions based on short-term emotion and sentiment.
I think so. I also think, and this is purely based on personal experience, and I have no scientific evidence to back this up, but I tend to be a hard data guy, and I will come home at night and my wife will say, "Hey, did you know that?" and fill in the blank. And we will have a conversation about, okay, where did that information come from? Is it credible? Can it be believed? I think the opportunity that people have to sensationalize things that may be partially true or not true at all, especially online.
Well, in the media, they want eyeballs. And
Right.
the way they get eyeballs is to sensationalize things. I don't know if you saw this, but this was probably 20 years ago. I formed Brogan Financial in 2001, so we're coming up on 24 years. I was pretty new in my career, maybe 3 or 4 years, and I remember there was a study, and maybe the timing's a little off, but basically whenever Time Magazine, like any major periodical that was not financial focused, like a Time Magazine, when they would come up with an article about the raging bull market and how attractive stocks are, we literally were within like 30 days on average from a market downturn.
I don't remember this study, but it seems unsurprising to me.
Yeah.
That seems very plausible.
But what do you say to people that say, "Oh, with markets near all-time highs, I don't want to invest in stocks"? The thing is, I could point to a lot of historical data points that say you should absolutely be in the market right now, even with the current valuations.
I would say, and everybody has a different risk tolerance, and so I don't want to talk about percentages, but I would say if you think you're going to be around for more than 15 or 20 years, and you have investable assets, my prior is that you should have some portion of those assets invested in equities. That's where you have, from a risk return perspective, that's where you have your highest expected bang for your buck over a longer, and we'll call it 10 plus years, over a longer time horizon.
Well, and I'm big, I talk about a lot on this show, that with some increased diversification, you can really, what we don't like in the markets is the big downturn, or what I would call the tail risk. Most markets are 65% of all markets, look at statistical measurements, or, think of a bell curve.
Yeah.
It's that outside 2.5% that can really be damaging on the downturn. And the reality is there's very cruel math in losses. You lose 50%, you got to make 100% to get back to where you were. Now you lose 20%, you have to make 25% to get back where you are. The math is not as cruel when the losses are less. So to me, for somebody that's not 40 years old with a 20-year investment horizon on their retirement account, it's hedging that real big downturn that I think can be very, very important. Any comments?
Well, I've got two. One is there's this thing in the finance academic literature, and it's been going on for at least 50 years, but it's called the equity premium puzzle. And it basically says, given what we think about how risk averse investors are, and given the risk that we expect in the stock markets, investors are getting paid way more than we think they should. And this is over long periods of time, and economists have struggled to explain this extra premium that you get for investing in equities for a really long time. And so far, I haven't seen a really compelling answer to this problem. It's just a puzzle that exists. So the payoffs are large. I think that's a compelling reason why people should be in the stock markets. As far as hedging risks from downturns, one of those hedges is clearly time.
I'd say historically over time is the number one hedge.
Yeah.
Right.
And the other is to make sure that you're not putting assets that you need in a very short period of time,
which we mentioned earlier,
goes to risk. As far as other hedges, I mean, there are a myriad of opinions on this, but one thing we know, and this is just an empirical finding, so this is just a data-driven answer to this, is what we want to look for when we talk about hedges is we want to look for things that don't act the same way. So we want, when stocks are down, we want something that goes up. But also what we know is that in a crisis, like the financial crisis of 2008, correlations go up. So everything sort of acts the same. But
to varying degrees.
To varying degrees, that's true. But the correlations, for example, between stocks and bonds go up in a crisis. The correlations between stocks and other assets go up. And so in some respects, it's really hard to find a perfect or really good hedge.
There's no perfect thing. When I ask the question, I'll just more kind of getting into the importance of trying to avoid that really, really big return. Of course, in our industry, there are a lot of ways to try to skin that cat. Some greater diversification of asset classes. Some would say own some volatility on the downside where you get convexity. A dollar pays 100 if it hits. You got that small drag on performance of the dollar. So whatever it is, there are different philosophies on that. I'm just kind of more hitting on the importance of avoiding that big loss because of that cruel math of losses. Yeah. I do want to ask real quickly before our next break. We're going to talk about the R word, Andy.
Okay.
There's more and more talk about a recession. I mentioned GDP, first quarter was negative, but that's misleading because of net imports or net exports. So how do we measure recession? When are we considered in a recession? We'll go back to an argument that came up several years ago in the political world because are we in recession?
Yeah, this is a construct that is really a little bit disappointing to talk about in the sense that there is no real definition of recession. So what happens is the NBER, which is the National Bureau of Economic Research, meets together. This is largely a group of financial economists, and they decide when we're in a recession, and they do it after the fact. So they look back at the data, at the historical data, and they say, hey, a recession actually started in June of 2008, and it ended in, June of 2009. Now, those aren't the correct dates for the financial crisis, but they do it after the fact. And something that has long been thought is that a necessary condition for a recession was 2 quarters of negative GDP growth, but that actually isn't true.
There's so many more data points.
Right. And we saw that during COVID, where the NBER actually said we were in a recession, but there weren't 2 consecutive quarters of negative GDP growth. And so, that is a thing that they look at, but they look at a myriad of other things, and they collectively decide when a recession has happened and when it hasn't.
Yeah. So to that point, when the recession, we're looking in the rearview mirror.
Correct.
Right.
Correct.
The market's looking forward.
That's right.
Right. So completely opposite. So normally by the time we even find out we're in a recession or we're in one, the market's already booming and recovering.
By the time we find out we were in a recession, usually the recession is, if not over, it's close to over.
Yeah. And the markets have already responded thinking in 7 or 8 months things are going to be better.
That's correct.
Yeah. All right. We're visiting with Dr. Andy Puckett. When we come back, I want to talk about this word stagflation. Also, what's going on with education for young folks today from somebody that's over there in the middle of the University of Tennessee dealing with students day in, day out. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in to More Living here on News Talk 98.7 WOKI. Check us out online, broganfinancial.com. We've got plenty of resources. If you click on the resources tab, you can also click on the radio tab and listen to all of our podcasts of our shows and our dollars and cents segments and our retirement minutes, which run every week right here on this station. We got Dr. Andy Puckett. We're talking about the impact of tariffs. Are we seeing a recessionary slowdown? We're talking about all these impacts and what it means for you as an investor, which I think the one thing I've heard the biggest, or at least that I'm coming out with, is we got to be careful. We need to stay invested. We might need to tweak things. We want to look for opportunities, but buying in and out can be very dangerous.
I would agree with what you said, and I also think making decisions, making personal decisions or making investment decisions based on information that you don't know whether or not it's going to be true in a day or 2 days or 3 days is problematic and probably is not going to end up.
Well, and is that information, even in the day of the information, being reported in a neutral way? Because it's not usually.
It probably is not.
Yeah.
Yeah.
So let's real quickly. Can you just talk about stagflation? What that means and the danger of it?
Yes, stagflation is a term that most commonly is used to describe the late 1970s. So it's when we had high inflation. So prices for goods and services were going up at its peak at a double-digit rate, in the low teens, and yet at the same time the economy was contracting. So we had a recessionary period. So often when you have inflation, you also have a growing economy, and that helps alleviate some of the pain of inflation. This is like a 1-2 sucker punch. You've got a shrinking economy, and you've got prices going up. So people are hurting on both ends, from an income side and a spending side.
Absolutely, that's very, very well said. And that's the one thing that I'm in my opinion is the most important thing to track is the inflation data. I think we're seeing the employment data stayed pretty constant, but some are expecting unemployment to go up, and many are expecting at least a one-time boost in inflation. So,
yeah, inflation right now. So the Federal Reserve, and you mentioned this earlier, which the Federal Reserve is just the central bank of the United States. And the Federal Reserve has two mandates. One is price stability, which means they're going to keep inflation in check, and they have this 2% target. And right now, inflation's checking in at 2.3%, which is right in line with what they are comfortable with. But if you dial back the clock, 2022 at this time, inflation peaked. It was 9.1% was the highest reading we had. But in the ensuing 12 months, we went from 9.1% to 3%. So within 12 months, it dropped. I think this is the largest drop in the quickest amount of time in inflation that we've ever had as a country. But I don't think inflation as we sit right now is problematic, but it is the potential inflation that can come in if all of these tariffs.
You've got to be very, very careful. Yeah, I just think it bears close watching. Andy, we're almost out of time. Talk about what's going on at the University of Tennessee and educating young folks. You're the department. You're just now starting as department head of the College of Finance. Talk about what you're seeing at UT in the financial world.
Yeah. So thanks for that lead in, and I'm honored to take over as department head for the Department of Finance and the Haslam College of Business. We're the number one major on the University of Tennessee's campus, and we see really, really exciting things. So we see 20 and 21 and 22-year-olds all day long who are just so sharp and so ready to get out there and are taking advantage of all kinds of internship and job opportunities. But I think that the field of finance for them is incredibly compelling, incredibly rich, and there are a lot of opportunities out there.
Great future opportunity.
Excited to be a part of that.
What'd you say off air? It was 30% of the College of Business is finance students?
This coming academic year, it'll be really close to 30%.
That's astounding.
Of the College of Business's students.
Well, Dr. Andy Puckett, University of Tennessee, thanks so much for taking time out of your busy schedule. This was just very invigorating for me to just talk about all this stuff.
Thanks, Jim. I really enjoyed it. Thank you for asking me on.
Absolutely. Hope you at home and in your car got a lot out of that. Today we've been talking about the world of money and finance and investing, because greater wealth provides for more living, so you can live the best years of your life your way. Many thanks to Wayne for engineering the show. Thank you to Jill for helping produce the show. Have a wonderful weekend. Go Big Orange today, tonight against Cincinnati in the regional. Have a great week. This is More Living with Jim Brogan, only on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.